Good morning, everybody, and welcome to our Ethical Investing Special Edition of HUBsights webinar. I'm Anne McDonald, Head of Marketing here at Hub24. If you're not a HUBsights regular, I'll just go through a few housekeeping items. The lines will remain muted throughout the presentation to prevent any background noise. So if you have any questions, please use the webinar control panel to send them through. We'll hold a combined Q&A at the end of the session. Today, we're delighted to be joined by David Lee from Impax Asset Management and Yen Wong from Altius Asset Management. So right now, I'm going to hand over to David, who is presenting on investment opportunities in the transition to a more sustainable global economy. Thank you.
Thank you, Anne. Thanks, everybody, for listening in today. So I'll start off with the equity side of things. So why is it a good idea to look at sustainability in the equity space? And I think the first point to note is that we really fundamentally believe environmental markets are higher growth compared to your regular economies for a number of reasons. Obviously, technology, environmental problems, and also tightening regulations from governments around the world who are recognizing these issues. We've seen earnings delivered over the last 10, 20 years increasingly moving faster than broad equities as measured by the MSCI. Also, we have a lot of mid-small cap companies in this space which are under-researched, so we feel that investors can find value add through active management equity portfolios. And Impax has been in this area for 20 years now, so we've honed in our skill set and built up a team who are able to cover the technologies and the regulations globally. And at the end of the day, we are very focused on fundamentals, which is the underlying earnings growth, good returns, good management teams, rather than just hypes or bubbles that you frequently see or frequently associate with these markets, like the solar bubble or the LED bubble, and currently EV bubble. So we try to find companies that play into that space without these kind of headline risks. So a bit on Impax. So we've been at it for 20 years. We mostly focus on listed equities. We do have some investment in private stuff, such as wind farms and solar farms. We also have some investments in property which have an environmental angle. So we fit them up with more efficient lifts, lighting, and rent them out to environmentally conscious tenants. So that's a new business model for us. We're now headquartered in London. We're a listed company, and we have offices in the US and in Hong Kong, where I am based. So currently, the assets under management is approaching 20 billion Aussie dollars. We made an acquisition earlier in the year in the US, which has beefed up our presence in the American market. So let's go to the fundamentals. So why do we think it's higher growth? Fundamentally, populations are still growing, in particular in emerging markets, and standards of living are rising. People are consuming more. Now, the backdrop remains the same. We have infrastructure deficits. This is not just an emerging market problem, but developed markets have dilapidated water systems, transport systems, power systems that need to be upgraded. And at the end of the day, there's a finite amount of resources, so we need to use these more efficiently and reuse some of these. And pollution is a huge problem in emerging markets. We've seen this on the press, talking about pollution in Beijing or Shanghai, but little is talked about in India, which is even worse. So they're also tackling with this serious problem through newer technologies. The way we look at these markets is in four main buckets. So we divide these classifications over the years. The biggest one is energy. And people often associate energy with solar farms and wind farms and picture of these in the brochures. But in fact, there's a lot to be done in energy efficiency for existing products and services, just like automobiles, buildings, factories, and in governments. So these are the areas where we find a lot of companies that are under-researched and employing newer technologies in order to really grab the low-hanging fruit to save energy and other resources. We also cover the water market. It's not just utilities. If you look around, everything you touch or do or eat or drink has some water in it. So be it drugs or food or washing machines or even turning on the light switch, a lot of the power that is generated requires a lot of water for cooling. A lot of that water is polluted, needs to be treated. So there are pumps and valves and filtration equipment that goes into these markets. Even going to McDonald's, they're very dirty if they don't clean them up. So you need a lot of detergents. These detergents need to be cleaned up after they're used. Then there's the waste side of things. We need to recover and reuse. Products now have to consider the life cycle, not just the point of consumption, but how do we deal with after consumption, all this rubbish ending up in islands in the Pacific, for example, these plastic bottles. Then you've got food and agriculture. We focus on the sustainable side of things, so we look at the whole value chain. How do we irrigate the farms better without wasting water? How do we use better pesticides and fertilizers? How do we package our food to extend the shelf life of food? Because much of the food is actually wasted. 30–40% of the food is actually not consumed, but end up in rubbish tips. So how do we package them or deploy cold chains which extend the life of these foods? And of course, we also cover health foods, supplements, and organics as well. So these are the broad markets. So you can see it's very diversified. We can establish very diversified portfolios which can withstand fluctuations in the market through the economic cycles. More on the drivers. So as you can see, most of the people in the world live in emerging markets where the income levels are still very low and are projected to grow in the range of 9%. As you can see, they're going to consume a lot more meats, a lot more appliances, clothing, footwear we take for granted. They are going to consume a lot of this stuff, and really the world cannot support this. And so, for example, for transportation, it's not possible that we all drive cars. So we need to look at public transportation, and where there are cars, we look at the electrification of cars or hybrids. And then consumption of meat, people take it for granted. We have meat in our diet, but meat consumption of water is 4 to 9 times more than consuming vegetables. So a lot of places in the world are under water stress, so it's not possible that everybody consumes in the current way that the developed markets do. So we have to look at agriculture in a different way. Precision agriculture is a big thing. Another important thing to notice in these markets is really the importance of governments and their role in formulating policies and regulations. Some of these come about because of scandals, for example. Just say in Japan, we had the big disaster with the nuclear accident. Now they are going back to renewables and thinking about how to address their energy needs, moving back to natural gas, and also making their manufacturing or buildings more energy efficient. So new laws have been passed pushing for zero energy buildings, for example, and also driving the leadership even further, because Japan has always been a leader in energy efficiency for cars, for factories, and now they're really exporting this technology to emerging markets, for example, in China and India. China, on the other hand, is a big consumer of environmental services and products. So everybody knows the pollution problems. They burn too much coal. They are now moving to cleaner transport. They're building a lot of subways and high-speed rail systems. And the water value chain is a big one. In Asia, a lot of it is actually run by the governments. Increasingly, governments find that they cannot afford to build all this infrastructure with their own money. So there's a lot of privatization taking place, where wastewater is now treated by private enterprises through BOT contracts. We're seeing the same thing happen in India, which is in more water stress. And this goes for developed markets as well, as I mentioned earlier. The US has droughts in California, but floods on the other side of the country. So mitigation and adaptation are two areas that developed markets are also looking at investing their monies. So, policy support has been very consistent, has grown in strength. And I think in China this year, we've seen a lot of clamping down of environmental issues where companies are not abiding by the law. So we focus a lot on the environmental regulations that are being promulgated in these countries. Some of you might have heard of the word impact. That's kind of the latest iteration of what sustainability is, how it's measured. Most investors now want to see where their investments are going and how that's really creating a difference in the world. So the way we look at it from Impax's point of view is that we start off with companies that have a solution, either a service or a product that addresses these problems. So in itself, we are looking at solution providers that will create an impact, and that can be measured in a quantifiable way, and our investors are able to see every dollar that they invest in the portfolio, what they can actually achieve. We also seek to engage companies because quite a number of companies still don't know what to disclose and what investors really want to see. So we educate some of the companies in terms of the metrics that they should communicate to the investment public. And at the end of the day, we also manage the portfolio to reduce the ESG risks that these companies face. Fossil fuel divestment is what has been talked about, but a lot of other risks, environmental damage, accidents, labor disputes, sourcing of materials from companies that deforest or harm the broader environment. These are all the risks that can surface. We talked about pollution control. We talked about, for example, Volkswagen. That's a huge accident which caused significant damage to the share price. Not to mention the oil spills like BP. And at the end of the day, we also look at companies that don't comply and we divest. So we're very stringent on our requirements. So, that's one of the big movements in a lot of the universities out there, divesting fossil fuel companies or fossil fuel stocks. So these are all the things that we look at in order to manage this risk. The next two slides kind of spells out what we do in more detail. Perhaps I'll skip these two and go to the measurement. Inherent in what we do in selecting proactively. So we don't just negative screen, we actually pick companies that have a positive environmental impact or a solution. So we actually go and measure what the activities of these companies do in terms of the net CO2 emissions, so in terms of the manufacturing side, how much they emit, but also in terms of their products in the fields. When you deploy their services or products, how much savings do you achieve in terms of CO2 or waste? So we calculate a net figure, which is very important. I think we can't just say manufacturing is bad. We also have to look at, okay, if you're manufacturing, say, a solar panel, obviously the manufacturing of the panels will emit carbon. But what if you deploy these solar panels in the field? How much do you save in terms of carbon? So the net figure is what we focus on. We also measure the renewable energy that's generated. We also measure the water which is recycled or processed. We also measure the materials that are consumed or saved or recovered. So at the end, we're able to communicate to investors how you are going to help the global economy achieve a 2-degree, within the 2-degree economy, what the Paris Accord has agreed to, and how this strategy is contributing to it. So on this slide, you can see how the global economy, this is more of a hypothetical example of a $10 million US dollar investment in the global economy would look like. So if you have $10 million US dollars, you put it into a global economy and in a hypothetical kind of portfolio, you're emitting about 2,500 tons of CO2 on a net basis, which is way beyond the 2-degree economy needs. Basically, it's twice that figure. So we are on track to go way beyond the 2-degree economy. So that's why we need to change the current way of living or investing. The Impax strategy actually produces a net saving in this regard. I have to emphasize this is a hypothetical kind of portfolio because we don't do kind of extractive industries, we don't do banks. So this is an area where investors can really think about in terms of impact, what they really do with their money. And do you really need to invest in the global economy, or do you have better choices out there? And I think we offer one of the potential choices for you in terms of creating impact. Okay, so this is a very transparent slide. We measure these numbers and we communicate to investors. So this is a very bottom-up driven research. We talk to all of our companies and we ask them what they produce, how much emissions they generate every year, and how much savings they generate every year. And they're aggregated at the portfolio level. So for a $10 million investment you make in this portfolio, you are actually saving 280 tons of CO2, for example, and you're treating or recycling over 2,000 liters of water, and also producing renewable energies and recovering waste. So this is a very powerful statement to make for people who have an interest in making a difference with the investment dollar. And last slide I'd like to mention is that the UN has come up with 20 sustainable development goals. And we like to match what we do with these goals. And these are 3 examples of where we are matching those very closely. First of all is the clean water and sanitation. We do invest in companies that treat a lot of wastewater, which in many countries in the developing markets are not treated. We also invest in companies that are deploying new technologies, and that's one of the goals, deploying technologies in infrastructure. So insulating material, LED lighting, for example. In this case, this company produces insulating boards for buildings, and they are very significant savings in terms of the energy bill for buildings that have deployed these solutions. And the third example is really a recycling company. One of the sustainable development goals is really building more sustainable cities. So a lot of the waste in these cities sometimes are just exported. You've seen in the press now, a lot of American plastics are really shipped overseas to China and India, for example. And China turned around and said, well, we're not going to take these plastics anymore. So more of these service providers are seeing very strong demand as these plastics really need to be recycled and reused. So this company actually is saving 100% one-for-one in terms of the plastics that are consumed by the cities. So these are the things I think investors should bear in mind with when they look at what is sustainable investing and what is real positive screening, rather than just screening out companies and not really able to communicate an impact statement such as this. So I think that completes my presentation. So I'll pass it on back to Tan.
Thanks very much, David. And now we have Yen Wong, who's going to present on ESG and fixed income from Altius Asset Management. Thanks, Yen.
Okay, well, thank you, Anne, and also thank you to HUB24 for having me, and thank you to everyone listening in today. I'm Yen Wong, and I'm head of credit research at Altius Asset Management, so I'm responsible for looking after the corporates and credits that we own, and also for doing the ESG risk assessment on the issuers we buy. And today I'm going to talk about the environmental, social, and governance risk, or ESG risk for short, and fixed income, why it matters. The biggest challenge in ESG risk assessment for fixed income and possibly for equity investors as well, beyond ESG, what's next? I think David's already touched on a lot of that. And walk through how we assess ESG risk for the issuers that we assess. Disclaimer. Okay, very simply, besides fiduciary responsibility and recognizing investors' duty, as long-term stewards of capital, the risks are becoming more visible. ESG risks are once considered long-term systemic risks, but they're starting to bite, and here is an example. These are headlines from the Financial Times. On the left-hand side, Warren Buffett was quoted as saying climate change posed no risk to Berkshire Hathaway. And you fast forward to late 2017, and Berkshire reported its first underwriting loss after taking a US $3 billion hit from natural disasters. 2017 was an exceptional year for hurricanes, with record-breaking series of hurricanes like Irma, Harvey, and Maria, which swept through the Caribbean and the US, causing tens of billions of dollars in losses. Climate experts have said, in a warming world, the fatal events will continue to worsen. Munich Re has said the final insurance bill for the Atlantic hurricanes, including a severe earthquake in Mexico, is expected to come to a US $135 billion, a figure that is higher than ever before, and overall losses, including uninsured losses, amounted to US $330 billion, the second highest figure ever recorded for natural disasters. There is a cost to doing nothing, for business to continue as usual. Businesses cannot afford it, and investors cannot afford to ignore it. And the rating agencies are starting to consider these issues. Here is a snapshot of a rating action by S&P related to environment and climate risk from a PRI report. You can see on this chart that the downgrades in rating and outlook account for over 75% of rating actions. There is clearly a downside rating bias, which is completely consistent with the risk profile of the investment class. Interestingly, according to the PRI, full ESG integration in fixed income appears some way off. Now, corporate ESG coverage and assessment is well understood, but we believe that ESG risk can have a greater impact on government issuers as pressure on society or the environment can impact a government's ability to raise revenue, or it could potentially increase their costs, which then impacts the government's credit profile and ability to borrow to fund their financing. This is a list of the largest corporate defaults rated by S&P. In the fixed income world, you get broad agreement that weak standard of corporate governance or governance failures are a contributing factor to company defaults. The first three named on the list, Enron, WorldCom, and Parmalat, are classic examples of governance failures, leading to corporate debt default and shareholder value destruction as well. Now, I'm going to talk about the biggest challenge in ESG risk assessment. This is a chart of Tokyo Electric Power Company, or TEPCO for short. This is its share price and the S&P ratings prior to and post the 2011 devastating earthquake and tsunami in Japan. The boxes that are highlighted in red are the ESG events or news for TEPCO, and the others are some of the news within the Japanese nuclear power sector. Now, TEPCO has a known history of safety violations. They have falsified repair standards. And if you were to look at their ESG risk prior to the 2011 earthquakes, there were plenty of red flags. Clues the company was not managing their environmental risks nor their social sustainability well. When you dig a little deeper, the issues in TEPCO are not quite unique for the company. In Japan's nuclear industry, there appears to be a persistent failure by regulators to regulate. The biggest challenge for ESG assessment is assessing this regulatory or the industry governance risk. Here are some more pictures, and this is of the Fukushima plant in Japan. And 7 years on from the disaster, Japan is still wrestling over what to do with the ever-growing pile of radioactive waste. Regulatory failure occurs when agencies inadequately fulfill their oversight, supervisory, or enforcement functions. Regulatory failure can also happen when the system is deeply flawed, when it is over or under-regulated, or when the design is based on old science. They can go undetected for some time until they're exposed by a crisis, such as the BP oil spill in 2010, or the financial crisis that started in Wall Street in 2008. The industry governance or regulatory risk could well be the hardest ESG risk to assess. I guess one way of assessing this risk may be to understand the capture of the regulator by the regulated. By this, I mean the corporate and issuers or players in the sector. Now, Japan had the third highest nuclear power by capacity behind the US and France. They also have a track record of downplaying the potential risk. Now, prior to the 2011 earthquake, 30% of electricity was generated from nuclear power, with a planned expansion of that share to 50% by 2030. The loss of public trust post the earthquake meant that nuclear's contribution dropped to less than 1% by 2015. The cost to government was in excess of 22 trillion yen. And nuclear investment is excluded from the Altius Sustainable Bond Fund. But here you can see it is not all bad news, as David talked about in his slide. The share of Japan's electricity production from renewables, although still low, it has grown rapidly since 2010. It makes up about 15% of total electricity production. Japan is not the only one interested in renewables. Globally, we have seen strong growth in green investments, Fixed income are generally considered behind equities in the ESG integration, but there has been massive growth in green bond issuance. These bonds are playing an important role in raising awareness of environmental factors for the fixed income market. And this increasing ESG awareness is also driving demand for innovative solutions. We're seeing that growth in impact investments, as David's just talked about. Impact investments are investment made into companies or organizations or assets with the intention to generate a measurable, beneficial social or environmental impact alongside a financial return. This environmental awareness has also led investors to increasingly align themselves with the Sustainable Development Goals, or SDG for short. The UN has poured political capital behind the goals, with asset owners' interest in the SDG reportedly going mainstream. And we've seen ANZ Bank here issue their first SDG bond in the Euro market last month. So what are the SDGs? The Sustainable Development Goals, or global goals, are a universal call to action to end poverty, protect the planet, and ensure that all people enjoy peace and prosperity. It was introduced in 2015 when the Millennium Development Goal, or MDG, expired. It is both a challenge to lift and keep people out of poverty, as it's generally the poor whose lives or livelihoods are more vulnerable and immediately threatened by the effects of climate change or pollution or inequality, as well as other pressures. The key difference between the MDG and SDG are the SDG is more comprehensive. It has a broadened scope to include peace, stability, human rights, and good governance. It invites contribution to include all levels of government, businesses, and global citizens. There's also better articulation or interlinkage between the SDGs on how to lift and also keep people out of poverty. The SDGs will shape investment opportunities and guide companies to more sustainable business practices, products, and services. There are 17 goals with 169 targets, but not all goals are relevant to all organizations. The goals are a convenient framework to define the impact for an investment. Now, why is it important? I think David has also talked about this. The sustainability has moved from, screening out to integrating ESG risk. But I think there are investors and I think businesses as well would like to move just beyond mitigating. And this SDG is a broad and good framework to determine the intended social and environmental impact of an investment or project. It can also enable everyone to participate in growing the economy in a sustainable fashion. The goals can apply to everyone, and the UN has specifically invited corporates and financial institutions to contribute towards achieving the goals. And some of the largest pension funds and asset managers, such as Impax, have taken up this challenge. Now, I'm going to talk through two examples in the Sustainable Bond Fund of issuers where we've excluded due to ESG risk, which we have considered unacceptable, and we believe that poses risk for the credit. Some of you may recognize this name. This is Wells Fargo Bank. It is the third largest bank in the US by assets. It is also the third largest bank globally by market capitalization, behind JP Morgan and Bank of America. This bank, for a few years now, has been mired in scandals. In 2016, they faced over US $185 million in fines over unauthorized accounts. And the bank subsequently announced various changes. You can see photos of the CEO testifying to Congress. So they've announced changes to programs and products such as an end to broker bonuses. And they've also made changes to improve their board composition, to separate the chairman and CEO role, to improve governance and oversight. But in 2017, more scandals emerged when they uncovered more fake accounts, making customers pay for car insurance they did not need. The bank then subsequently faced lawsuits, federal and state investigations, fines, and grilling from, and more grilling from Congress. Their legal bill amounted to US $3.3 billion by the fourth quarter of 2017. We've excluded Wells Fargo from the Sustainable Bond Fund last year amidst all the emerging scandals because we believe it would weaken the credit profile. In addition to a thorough fundamental credit assessment, we overlaid this ESG risk assessment, which led to a downgrade of the Altius credit score and a negative outlook on Wells Fargo. In February 2018, so this is just last month, the Federal Reserve banned Wells Fargo from getting bigger until they can convince regulators that it has cleaned up its act. The chart on the bottom left-hand side shows how the share price fell 9% immediately following the Fed's announcement, and the credit spread, which is the green line, increased and has remained elevated. This was followed by downgrade rating actions from S&P and Moody's. Well, what does this mean? Well, the bank has destroyed shareholder value because they've undermined the trust that's, been given them, and the cost of raising debt as well has increased. So, this is a very, material example of how when ESG risk is not managed well, it impacts the credit, how it can impact the credit. And closer to home, we have a name you're more familiar with. This is the Commonwealth Bank. CBA's woes started with the financial planning scandals, but it didn't stop there. The financial planning scandals exposed the forgery and fraud and cover-up by management. And then they had issues with the life insurance business, very serious issues where they put profit before sick and dying customers. And then you had the rate reading scandals, and then finally the Austrac money laundering scandal, which would suggest that it is not a isolated one-off issue. It looks like a more persistent systemic issue, well, not just for CBA, but also for some of the banks in the Australian marketplace. And this has now led to a royal commission into the banking sector. And CBA has also been excluded from the Sustainable Bond Fund because we do believe it will impact the credit risk. This is just a schematic of our investment process to show you where credit research and our ESG overlay fits in. We are also supported by a sustainable advisory committee, which has external parties in the committee where we meet every quarter. And I will just finish on that slide. This is a little bit more about the Sustainable Bond Fund. Thank you.
Thank you very much, Yen. It's interesting to see the corporates signing up to those UN Sustainable Development Goals. I hadn't heard about them before today. So we're just going to switch over to some questions now. One for David. What do you see investment opportunities in the renewable energy space?
Okay, first of all, everybody's looked at renewables as the holy grail, but it's kind of stop-start. It's delivered quite well, but then slows out, explodes, goes back down. So it's been a very volatile market. And I think for us, we focus on the regulations very tightly. That's the most important because up to now, in a lot of markets, renewables still rely on subsidies. In a few markets, it's pretty much at grid parity. So at the moment, we are not looking at the equipment side because the cost still has to come down a bit more. We are selectively looking at the farms, the solar or the wind developers in markets which are more stable. So where governments have strong financing. So those companies have zero fuel costs and zero price risk because they are already competitive in the natural market without government subsidies. So as I mentioned earlier, we have a private equity fund. They invest directly in these developers. And the attraction there is that they have a very stable yield. And insurance companies or retirement funds look at these as very long-term yield-enhancing instruments. So that's where we are. Impax is, doing well.
Okay, thank you. And another one here, which you mentioned car consumption on the increase. What is Impax's view on Tesla?
We are skeptical on Tesla, which has proven itself. Thank God.
Don't let Elon hear you say that.
There are a number of reasons. It's a single product, pretty much. And it's a niche product as well. It's quite expensive. So we felt that they can dominate the niche market, but they they haven't demonstrated the ability to capture the mass market. And it's very much got technologies which are not proprietary to them. We feel other companies like the Toyotas or the Fords or the GMs or the Volvos or the Volkswagen of this world, they can replicate when the market is big enough, when the price point has reached the masses. So we felt that it's more interesting to look at companies that are not just focused on one brand, but component companies that supply broadly to all the automakers. So it could be hybrids even, it could be turbochargers, it could be catalytic converters, it could be connectors, wiring, which are very common. They already make good money. I would have to take the technology risk as well, which is very important. Technology is not quite there yet in terms of cost. So far, we've not really invested in Tesla directly, but more kind of indirectly.
Good to know. And Yen, what weighting is given to environmental versus social versus governance factors when assessing ESG risk? And what weighting is given to the ESG assessment when making the investment decision?
I hate this answer, but it's it depends answer. It would depend on the type of company it is and what sector it's in. So, for instance, for financial institutions, the direct environmental footprint would be very low. It's what they consume. Whereas when you look at their indirect environmental footprint, it could be far larger. Given and again, it depends on what types of assets or businesses they finance. I'd say probably for a financial institution, the social and governance risk factor may matter more in the near term than the environmental factors, because the product responsibility or consumer relations or business integrity are important risk factors. It is what could undermine your revenue growth, or it could or in the case of Wells Fargo and CBA, it could make the regulators more focused on your business operations. In Wells Fargo's case, the regulator or the Fed has stepped in to say, well, you can't grow anymore unless you clean up your processes and you improve your risk management and your governance processes.
Thank you. And second question here, can ESG analysis be applied to government sovereign bonds?
Yes, they can. I've had to write this down because there are different factors of KPI that would apply for government issuers. So it is risk factors that could impact the economy or the government's ability to either raise revenue or potentially increase its costs. So there are more macro factors that would impact a government issuer. So things like, diversity, gender gap, biodiversity, vulnerability to climate change, the physical risk of climate change, those are sorts of the issues that you might need to look at when assessing the risk for a government issuer.
Lots of factors to take into consideration. Okay, so it looks like we've reached the end of our questions for today. I'd like to thank both David and Yen for being here. As always, if you would like to get in touch with Impax or Altius, please get in touch with us or your local BDM, and we'd be happy to put you in contact. And we look forward to seeing you next time. Thank you.
Thank you very much.
Thank you.